Welcome to today's video. In today's video, we're talking about liquidity, especially liquidity in SMC, smart money concept. Please, this is a very important aspect of SMC. In fact, it is the most important aspect of SMC. Liquidity is the most important aspect of understanding how to trade using smart money concept, because to smart money concept, everything about the market is all about a hunt for what liquidity. Now, what is this liquidity? The normal textbook version will tell you, okay, liquidity is what is required for you to be able to buy and sell asset quickly. Okay, for a particular asset, if there's liquidity, you'll be able to buy and sell that asset real quick. But in SMC, liquidity is the money required to what move the market. We believe that for a market to move from one point to another point, it is liquidity that causes that market to make such moves. So it's an important aspect. So the ability to be able to spot these different types of liquidity in the market in order for us to catch our trade is what we are going to be actually talking about in this video. Okay, so pay attention very well. So there are basically two forms, or let me say types of liquidity, and we'll be identifying those liquidity in this those types of liquidity in this video. So please, the first one is called say dynamic liquidity. Okay, don't worry about the big grammar, just a simple concept. Well, we also have the second type of liquidity, is the one known as, where's my text tool? Okay, static liquidity. That's the top two, second type, static. Just by the term, just like what it implies, according to the word static, you're able to explain it. Okay, so it's kind of simple. So these are the two major forms of liquidity we have in the market: dynamic liquidity and static liquidity. So let's start with the first one, which is dynamic liquidity. What it simply means is, dynamic liquidity is just the liquidity that determines market direction and movement. In other words, what makes market to move up or down, the direction. For example, okay, for example, we know if market's in an uptrend, market moves this way, right? Swing lows to swing high, from what another swing low to a swing high. Now, under dynamic liquidity, it is that liquidity that determines market direction and market movement. It is dynamic liquidity that is created as the market moves. Okay, it is dynamic, it is not static, it is moving. Okay, as the market moves. Now, under dynamic liquidity, we also have two types of liquidity under this part of liquidity. So let me just put it here so you guys understand. We'll use the Roman. Okay, something like this. How would I write it? Okay, we have two types, and the first one is internal range liquidity. So I'll just put that one as internal liquidity. And it is very important. What I'm doing is very important, that you know the types of liquidity available in the market and you know how to identify them, so you know how to take your trades. Okay, so don't say this is theory. It is very important that you know all those things. We also have internal liquidity, then we have external liquidity. Now, under the dynamic liquidity, dynamic, from what I explained, is that liquidity required to move the market. Like I said, liquidity is important for SMC because we believe that as market moves, all about liquidity. When market is pumping, when market is dumping, whenever it's ranging, it's all about building and hunting for liquidity. So that is the major concept. So that's why I started with market structure, understanding all those things. But now we are talking about liquidity. The video is going to be on different parts because it's an important and long concept. So this is just like the introduction, show you guys how what it entails. Okay, so first we have dynamic. Now, under dynamic liquidity, we have internal range and we have external range liquidity, which is what I've just put it out here. It means And under this dynamic liquidity, which is liquidity that is created and being swept as market moves, we have internal, external. So on this theory, it means market cannot move without taking out liquidity. It means for market to move, market moves from either internal liquidity to external liquidity, or from external liquidity to internal liquidity interchangeably. So before a market moves, it must move within, how do I use that? It must move from what? Internal liquidity to external, and from external to internal. Now let's identify what this means. Remember, let's come back to this swing structure, right? When market creates a swing low, moves from a swing low to a swing high, right? And creates another swing low to a swing high. Now, internal liquidities are liquidity created inside a swing for market to move, right? And those liquidity as what we called fair value gaps, right? While external liquidity are the swing liquidity found at every swing low to a swing high. For example, if market creates this, let me draw this structure again so you guys understand very clearly. Okay, let me do this. Internal range, external, right? Now under internal liquidity we have, let me put this aside. I just want to make everything really clear for you guys to understand it. So internal liquidity, now under internal liquidity is categorized by fair value gaps, imbalances where the market creates, FVGs, right? We'll be doing another video talking about this extensively. Okay, and make this very clear. Okay, internal range characterized by FVGs, while external range categorized by swing highs and swing lows. When market creates that series of what swing highs. Oh no. Oh no, I want to drag you all. Come on, like this. It's making this thing not to be sweet. Okay. From swing highs, top of the swing highs, and swing lows. Okay, something like this. Okay, good. Now we understand dynamic. As the market moves, market creates this liquidity. So, for example, market's an uptrend when you have a swing high and a swing low. Break structure creates another swing high and a swing low. Break structure to the upside. Now, market is creating dynamic liquidity. The first ones are internal. For market to create a swing low to a swing high, right? This swing high is a what? Liquidity. An external range is called an external range liquidity. This means there's money found here, and at the bottom of this swing low, it means money is also here. Then market moves for market to create a movement from this swing low to another swing high. Market must what? Move from an internal range liquidity, which is fair value gaps, right? So you can see how market moves. So as it moves, creates new swing high, it creates another what? Fair value gap, FVG, right, on the swing, while sweeping an external range liquidity also at the top right here. So how does this market move? It means for market to move, market will what? Go from an internal range liquidity, right? Then to an what? External range liquidity, create a new external range liquidity, move into an internal range liquidity, out again to an external range liquidity. So when market creates this break of structure, those are what it does, right? Moving from internal, what's the internal range liquidity now? Fair value gaps. What's the external range liquidity? The previous high we created. Tap into internal to create another high. While it's moving from an internal to create a new high, it's also sweeping what? An external range liquidity. Now, it also what? While moving from this fair value gap to create a new swing high, right? it has also created another what? Market creates another what? Fair value gap. This is how SMC sees the market. So before market moves, it needs to come and take what? The internal range liquidity again, then go above to sweep what? The external range liquidity at the top. That's how the market moves. So for market to move, it means it needs to move from what? An internal range liquidity to an external, or from external range liquidity to an internal range liquidity. I hope this is very, very clear. So at the highs and lows of every swing candle, at the highs and low of every swing, markets what? Their liquidity resting there. So for market to move, market needs to come what? Fill the internal one, sweep the internal range, then go ahead to what? Take out the external range liquidity. That's why we have typical market structure. When I was explaining in the market way, if market is creating swing highs and swing low, you see market come out, take out a particular swing low, which is there is external range liquidity low, and go ahead to create this move. So what did the market do? The market went for an internal range liquidity that has not been filled here, and also took out, because this is swing low, this is swing high also. Now it came back down, went for an internal range liquidity FVG, also swept an external range liquidity low, which is here. While coming down, it took that out, tap into the FVG. Then as it's going back up again, it's also going to sweep another external range liquidity here, because now we have swing high and swing low as liquidity. So how does the market move? From a swing low to a swing high, it comes down, fill an FVG, sweeps an external range, and goes back up to take out another external range liquidity. Okay, so if you understand this concept, is the basic way market moves, and this is what we call dynamic liquidity that is created on the go. So it means market will continue creating this liquidity as it moves, comes back to hunt them. As it goes again, it will create, comes back to hunt them, creating it uptrend and a downtrend. So same thing in a downtrend scenario. Okay, when you have market moving like this, creating that highs and low. Okay, so the market creates external range liquidity right here. There's an external range liquidity at the top of this swing high, right? Market will come into that swing high. There's an FVG here, okay, which is internal, and market has also created an external here. Okay, so for this market to move, it needs to what? Move from this external that it has created, tapped into an internal, then move from this internal back into the external while sweeping the external. Then while creating a new swing, market does the same thing, creates an imbalance again, which is a fair value gap. For it to continue moving, market will create this external range liquidity right here at the bottom of this swing, right? At the bottom of this swing, why is it not drawing? Okay, at the bottom of this swing right here. But for market to move, market needs to what? Move into what? Internal range liquidity again. After tapping into internal range, it will come back and push to the outer to create that swing and sweep in the external range liquidity. This is just what dynamic liquidity is. Internal range to external. So if you understand it means market moves from one point, one internal, to an external. So the idea is that market what creates liquidity for its momentum, right? As it moves, it creates that liquidity. Now if the price does not sweep liquidity before a key level, it will use that key level as liquidity to fuel its momentum. For example, this affects a lot of people, right? You marked out a demand zone, a beautiful demand zone, right? And this demand zone, market pumped from this demand, made an impulsive move, right? And you know market is supposed to come back here, but there's no internal range liquidity, there's no external range liquidity. The market will not move like this, right? So what it will basically do is wanting to sweep that external range liquidity before it moves. So it will want to move like this, taking it out, because it needs a momentum, it needs something. So this swing low is an external range of liquidity. So if there's no internal range for it to sweep to go and target this external, it's going to use this one as its momentum, then go and target the external range liquidity. Do you understand? That's why we call a low like this. Now, if it does something like this, it has created a new low. We call a low like this protected because it has swept before moving, creating a break of structure. It swept a previous low. You understand? So SMC, we call this protected low. I've explained that on our previous video. So market needs that. So just take note, if the price does not sweep liquidity before a key level, it often use that key level as liquidity uh to fuel its momentum for the move. Okay, it wants to. That's why you see when price moves like this, all of a sudden price will come and take out a previous low, tap into this range for a continuation, because it wants to fuel its move, so it come and target a previous liquidity. So you need to see that. So it's dangerous to enter at this point when you know that, oh, market has not swept a particular liquidity for its move, because if it's moving like this, it will definitely come and take out one low or take out all the lows, creating um, trend line liquidity. We'll talk about that when we enter static liquidity. So I believe you guys have understood a little bit of what I've been trying to explain here. Okay, so these are the two forms. So identifying, you know that okay, market moves in this way, so you want to be very very intelligent to spot those moves. Okay, now let's quickly go to static liquidity. I don't want this video, just an introduction before the second part where we're going to charts to identify them, but it's important that you know this because liquidity is an important aspect of XMC. Now, static liquidity. Now, static liquidity just refers to zones in the market where there are large pool of money, where money is resting, where such as a stop loss of people, buy and sell orders of people, where money is resting. For example, you can check liquidity heat map. You're going to see the liquidity pool where certain areas or zones and price level, depending on the pair you're trading, where there are lots of money. So those are areas called static liquidity. And how can we identify them in the chart? It's quite simple. Okay, let me copy this. So for static liquidity, right, that is where it is more technical. Okay, no, I'm not resetting price view. Go back. Okay, I'm trying to map out. Oh my god, I just went away from this. Is the ETH chart. Okay, this is it. Oh, it has scattered everything. It has scattered everything we were doing. Okay, good. I wanted to copy this so I can explain this on another side that's quite clear. Okay, good. It's not pasting. Okay, let me just retype it because it's not pasting. Okay, static liquidity. We'll talk about this and we'll end this video because I don't want it to be too long. It's already taking long. Static liquidity. Okay. Now, like I said, it is liquidity that is resting, right, on specific zones in the market where there are pool of money, and all market will definitely go and take out such liquidity. So it's an important you know how this or such how this liquidity forms. Okay, now you static liquidity can be identified on areas like equal lows. There's so many ways to identify them. The first one is equal lows. Don't worry, we'll go to chart. We'll go to the chart the next video to identify. But I really need to tell you guys all these things. Okay, you can find static liquidity below what equal lows. Put that equal lows and highs. And highs. So let me just do it like this. For example, what are equal lows and highs? Those stuffs you call the double bottom. when markets create something like this, double bottom or double tops or triple bottoms, or so these are equal lows. Chart patterns, double bottom chart patterns like this. All this one we use as reversal patterns. When market creates a double bottom or a double top, it's always acting. Those areas are what? Liquidity pool zones. So lots of money resting at this area, and you discover that most time price will come and take them out right before a continuation in its proper direction where price wants to go. Okay, so equal lows, equal highs. You can also have triple bottom lows, not just only equal low, only two equal lows. You can have when price creates triple bottom like this, triple bottom or what, triple tops. When SMC traders, we see this kind of thing and market is coming towards a triple bottom or triple top, we don't enter our trade here. We want to run away from those trades when market creates this, because it will always want to what, sweep it out. Okay, that's the triple bottom. And for the triple top, you see something like this. So there are always static liquidity resting at these zones. So this, when you see something like this in the market, for example, this triple bottom, when market has created it, for chart patterns, it's a reversal, bullish reversal pattern, of course. But after it has done its move all the way to the top, discover the market will still come, right, and sweep it as liquidity before a continuation to the upside. So this is the kind of things we SMC traders we identify, because once we see something like this, and of course maybe there's a demand zone below this level, we want to pay attention to it, because market definitely will come and take it out. So where static liquidity is resting, same thing for this, market will definitely come back, take it out before a continuation to the upside. Same thing in a bearish or bullish scenario, market will want to come back and take it out. Okay, so we want to be able to identify these zones. So these are one area where liquidity is resting. Now I'm showing you, not just telling you liquidity, how to identify them when you see points like that. Now above swing highs and swing lows of daily candles, like we've explained, for example, okay, let me put this right here. First one I said below swing highs and swing lows, for the below equal lows and equal highs. 2, you can define static liquidity at swing highs and swing lows of the daily chart, the weekly chart, monthly chart. So any, for example, if this, it's a previous daily high, or previous, maybe the market did a swing like this, okay, something like this, and this is on the daily chart. So below this swing, previous low, previous low, previous day low, and previous day high, there's always what, static liquidity resting. There's always liquidity on the previous daily low, previous daily high, previous weekly low, previous weekly high, previous monthly low, previous monthly high. Those high time frame zones, okay, there's always static liquidity resting there. So it's an important aspect that, okay, if you are trading if you are trading on the next day and market is actually moving towards a particular previous daily low, you understand, you want to be very, very careful, because market can end up sweeping the liquidity below the previous daily low before continuing to take out the liquidity above the previous daily high. So you can see moves like this, especially when the market is bullish. So you want to be very careful. If there are no liquidity inside for market to take, market can come and sweep the previous daily low liquidity, then go ahead to target the previous daily high. So it's very important you take note of that. Market can make such moves. So we can time this place as let's to type it PDH, PDL, previous daily low, and yeah, previous daily high. So something like this. Very important you take note of that. So that's why I'm doing all this identification. Swing highs and lows of the previous daily candles are zones. So let me just put swing PDH slash swing PDL. So previous daily low and previous daily high. Important you take note of that. So another area where we can find out static liquidity is trend lines. Oh please, um, trend lines. This is an important area where smart money usually trap traders, right? Below or above a trend line or a channel. Oh, I hope this video is not too long. Below or above trend line or channel or any other chart pattern market is creating. For example, this is very important. A lot of people, you see market creating, moving like this. For example, market creates a swing high, from a swing low to swing high, right? The market makes an internal structure again that creates a break of structure to the upside. Then all of a sudden market start moving. Let me bring this down. Then now market has created a swing low to swing high, right? And this one created this break of structure, right? Then market created another break of structure to the upside. Then after creating this break of structure to the upside, market started moving this way, creating smaller break of structures to the upside, moving in this bullish manner. Okay, while market is doing like this, what is it generating? It's generating what? Trend line liquidity at this part, right? You see that all of a sudden market will what? Will come down and sweep all the trend line liquidity right here, tap into zones of FVG or internal range liquidity before market continue to the upside, while trapping a lot of traders. Now this move is going to trap trend line traders, right? Trend line trader will say, oh, we have seen a breakout from this trend, then they want to go in for short. Then all of a sudden the market will reverse and go in for long. Such moves happen in the market. So in the next video we'll be explaining, we'll continue from where we stop. Basically there are other ways, other forms to identify this static liquidity in the market inside order blocks, above support and resistance levels, the top and low of a ranging market. When market breaks out from a ranging market, they are above the support level of that range, below the support level of the range, above the resistance level of that range. There are liquidity resting there that my price will take. So the next video will be looking at the practical aspect. We're going to our charts to identify it, but basically you can also study to know everything we've talked about. Liquidity, very very important aspect for SMC. So let's go, guys.